Welcome, everyone. Thank you for joining us today for our program, Partnership Interest as Tax Advantage Currency and REIT Portfolio Transactions. My name is Chip Cunningham, and I'm a partner in the firm's corporate team. I'm based in our Richmond office. Focus my practice on securities matters related to real estate private equity and fund formation, REITs, and other tax advantage investments. Today, I'm joined by my colleagues, Kathy Lawrence and Reese James, also on our corporate team.
Good morning. My name is Kathy Lawrence. I'm also a partner with the corporate team based out of our Richmond office. I focus my practice on the representation of both public and private companies, including real estate investment trusts, REITs, and other direct participation programs, and a variety of corporate securities matters and capital markets transactions.
I'm Reese James, and I'm based out of our Virginia Beach office. I primarily focus on private and public capital markets, corporate finance, and corporate governance issues, with a particular emphasis on Regulation A offerings across multiple industries, REITs, 1031 syndications, including TST and TIC offerings, and equity and debt private placements. Thank you all for joining.
Okay, now, before we kick off our program, I've got a few housekeeping items to go over. At any point during the presentation, you may submit questions by using the Q&A button at the bottom of your screen. Time permitting, we will address questions at the end of the presentation. If you're having difficulty with any audio or technical problems, please use that same Q&A button, and our marketing team will work to get those resolved quickly. Finally, you'll receive a copy of the presentation materials and a link to the recording by email later today, so you don't need to write everything down. Now, challenges and opportunities for REIT growth. REITs are by nature very capital-intensive businesses. REIT qualification rules require them to distribute much of their operating net income, at least that which can't be shielded for tax purposes. And so REITs frequently need to access equity and debt markets for those capital needs. But many, if not most, REITs are facing a challenging economic environment. Equity capital markets have been tepid over the past couple of years. On the other side, the days of free money debt financing seem distant, with interest rates spiking over the past year, and lending requirements becoming more strict. All the while, many REITs are finding it necessary to conserve the cash they can retain to fund inflating CapEx, tenant refitting, and the like. At the same time, there are abundant opportunities for REITs to grow externally by acquiring portfolios of still fundamentally sound real estate. Current economic conditions have created distress for some real estate owners. They may be facing significantly increased debt service from rising interest rates on floating rate loans, or eroding NOI, for example, from rising expenses, poor management, or inability to fund CapEx to keep the asset competitive. Other owner-sellers may be looking to diversify or liquidate, either for economic or strategical reasons. But both of these types of owner-sellers may have built-in gain in their assets. In this regard, an UPREIT provides opportunities. Let me take a minute to review the typical equity UPREIT structure for those in the audience who may not be as familiar with it. On the left hand of our slide, in an UPREIT, the REIT generally is a stock corporation that has elected to be taxed as a REIT for federal income tax purposes. The REIT, in turn, is the general partner and a significant limited partner of a subsidiary limited partnership, which is referred to as the operating partnership. The units of limited partnership interest in the operating partnership, referred to as OP units, are what our discussion focuses on. These are what REITs, or potentially funds seeking to UPREIT as part of an IPO or other strategic transaction, can use as consideration for acquisitions. We refer to portfolio transactions in the title of the webinar, but REITs can use OP units with acquisitions of single properties, a roll-up of one or more funds, and even acquiring management companies, subject in all instances to requalification. There are advantages of issuing OP units to a seller from the REIT's perspective. Namely, the transaction is cashless, or more accurately, cash light, as there are still hard cash costs to any transaction, but it allows the REIT to preserve cash. Typically, OP units carry very limited voting rights, almost none as far as individual contributed properties are concerned. And so the REIT as GP has control of the contributed properties. As with anything, there are exceptions. And I don't want to misconstrue things here. Issuing OP units clearly has an economic impact on the REIT, and REITs must assess whether an acquisition is accretive, just like a cash acquisition. But from a cash perspective, OP units provide an advantage. From the buyer's perspective, to the extent the buyer has built-in gain as receiving OP units versus cash, the buyer has potential deferral on that gain recognition, which we'll get to in a moment. and the buyer is likely obtaining some investment diversification through a larger portfolio of properties held through the operating partnership. But while there are opportunities, there are also structuring challenges from a tax, securities, and real estate perspective that any REIT looking at an OP unit transaction needs to consider. And that's where I'll hand it over to Reese to walk through high-level tax and some of the securities issues with Kathy, continuing that discussion.
Chip. So, as Chip mentioned, the primary purpose of the UPREIT structure is to permit a tax-deferred contribution into the REIT. If a property is sold to the REIT itself for cash or REIT shares, or to the OP for cash, and the seller has built-in gain, that's going to be a taxable transaction. So instead, the REIT forms its OP to give property sellers the option for tax-deferred contributions under Section 721 of the Internal Revenue Code. Generally, UPREITs are structured so that their common OP units are economically equivalent to common shares of the REIT. This is achieved through the combination of a few typical features. First, the only assets of the REIT itself are typically interests in the OP. And the REIT doesn't engage in any business activities outside of serving as the general partner of the OP. Secondly, each OP unit is entitled to receive distributions equal to the dividends paid on a share of REIT stock. And last, to enable OP unit holders to take advantage of greater REIT stock liquidity, as Kathy will discuss later, most operating partnership limited partnership agreements will provide that the holder may request redemption of the OP units after a typical holding period of about 1 year. For either REIT shares for either REIT shares on a one-for-one basis or for cash. Now, while contribution of property to a REIT's OP under Section 721 is generally tax efficient, there are potential challenges that can result in adverse or unexpected taxable events to the contributing partner. First, while a 721 transaction is generally tax deferred, if in connection with the contribution, the contributing partner, who is the property seller, so liabilities are reduced, which could occur, for example, when the contributed property is encumbered by mortgage debt assumed by the OP, then the amount of that reduction in liabilities will reduce the contributing partner's basis in its partnership interest. Importantly, if that basis is reduced below zero, then the amount of negative basis will be treated as a deemed taxable distribution to that contributing partner. Secondly, a 721 contribution merely defers the taxation of the contributor's built-in gain in the contributed property. Once the OP disposes of that contributed property in a taxable transaction, the tax on that built-in gain will be allocated to the contributor. Now, having become a limited partner, the contributor has thereby relinquished control of the timing of that taxable event to the REIT as general partner of the OP, absent a separate agreement made with the REIT at the time of contribution. To address these potential tax liabilities, most 721 contribution transactions include a tax protection agreement, whereby the REIT and/or OP will agree to temporal restrictions on taxable distributions of the contributed property, typically in the 7 to 10 year range. Often the REIT and OP will further agree to covenants regarding the maintenance and allocation of non-recourse liabilities on the contributed property to the contributing partner. Tax protection agreements may also contain provisions granting the contributing partner the opportunity to guarantee partnership liabilities to maintain the contributing partner's debt allocation. These are often done through vertical slice guarantees with respect to a portion of first to last loss of the applicable partnership debt. So we've talked about tax liabilities, but in addition to these various tax considerations, in structuring a 721 contribution transaction, any UPREIT seeking property for OP units also must bear in mind that those OP units are securities. Therefore, the offer and sale of them must either fit within the parameters of an exempt securities transaction, or the OP units must be registered. For single contributors, including entities where the owners do not have voting rights on the transaction, the contribution transaction was likely going to fall into Rule 506 of Regulation D or another private offering exemption. However, on the other hand, if the transaction involves multiple contributors or a contributor entity with a large number of equity holders who do have voting rights, then fitting into a transactional exemption may be much more difficult. though Rule 506C, which permits public advertising and solicitation to accredited investors only, may still be available. If no exemption is available, then the UPREIT will need to register its OP units, which could subject the transaction to complex disclosure and accounting rules surrounding the roll-up transactions. Therefore, care must be taken in structuring any registered contribution transaction. Of course, the initial issuance mechanics are only a part of the story with respect to securities transactions. So with that, I'll turn it over to my colleague, Kathy Lawrence, to discuss other securities concerns.
Thanks, Reese. So in terms of liquidity, unlike direct ownership of real property, which offers more limited liquidity, the typical UPREIT structure and contribution of property to the operating partnership in exchange for OP units provides enhanced liquidity by giving OP unit holders the right after a holding period, which is typically 1 year, to redeem all or any portion of their OP units, either for cash or more commonly for an equivalent number of shares of common stock in the REIT. While the redemption of OP units, whether for cash or for REIT shares, is a taxable transaction, which it triggers the taxable gain initially deferred when the property was contributed. The structure gives OP unit holders the ability to decide when and to what extent that tax liability will be triggered. If the REIT shares received in the redemption are publicly traded, a portion of those shares can often be immediately resold into the public market, with proceeds then used to pay taxes. In the case of a private REIT with no public market for its securities, a share redemption program may be needed to provide for some additional investor liquidity. With respect to resales, as Reese noted earlier, the initial issuance of OP units to a contributing partner in exchange for its real property is a securities transaction, which either needs to fall within an exemption from registration under the Securities Act or would need to be registered with the SEC. And the same is true for any subsequent resale of REIT shares received by a contributing partner upon redemption of its OP units. Resales of unregistered securities can often be accomplished under an exemption offered by Rule 144 of the Securities Act, which is subject to certain conditions that differ depending on whether the holder or the reseller is an affiliate or a non-affiliate of the REIT. Generally speaking, non-affiliates can rely on Rule 144 after just a 1-year holding period, which does include the period during which they held the original OP units. But with respect to affiliates of the REIT, which include its directors and officers, as well as any holder of 10% or more of its stock, affiliates are subject to not only the 1-year holding period, but also to more stringent requirements under Rule 144, including certain limitations on volume, the amounts that can be sold, and manner of sale, how and to whom those sales can be made, which can make the use of Rule 144 somewhat impractical. So to facilitate resales by larger contributors, meaning generally those deemed affiliates by virtue of their ownership of more than 10% of the REIT's stock, may instead be necessary to file a resale shelf registration statement with the SEC. The issuance of OP units in this kind of REIT portfolio transaction raises a number of additional considerations, both from a securities and just a general transactional perspective. These include the need to provide recipients of OP units with appropriate disclosure regarding the REIT, the operating partnership, the material terms of the transaction itself, valuations, tax consequences, risk factors, etc. In addition, in order to ensure compliance with the relevant private placement exemptions from registration under Regulation D, each recipient of OP units needs to qualify as an accredited investor, meaning they need to meet certain standards to ensure they have appropriate level of financial or business sophistication to understand the risks. And any non-accredited investor who doesn't meet those standards would instead need to be paid in cash rather than in OP units. And finally, with respect to any fund or other entity seeking to invest, the governing documents of that entity will dictate whether its members or limited partners have voting or approval rights with respect to the transaction, or if the fund's manager or general partner has the necessary drag-along rights to effectuate the transaction without the need for member or LP approval. And it's also worth noting that if the transaction and related OP unit issuances are being conducted in connection with the REIT's IPO, some additional considerations among a variety of others will include issues related to pricing, including portfolio and business valuation, and the allocation of that value among the contributors and management, as well as the potential need for any registration rights or rights agreements to facilitate resales by affiliates who are subject to the volume and manner of sale limitations under Rule 144, as I mentioned earlier. And with that, I'll turn it back over to Chip.
Thanks, Kathy. We're coming up on our time, but I do want to quickly note that ultimately in the background of these tax and securities issues, OP unit transactions are still very much real estate transactions. that have debt considerations, real estate closing considerations, and key vendor agreement considerations for consent that would need to be worked through. I think that's going to bring us to the end of our presentation. If you've submitted a question, in the meantime, we will follow up with you as soon as possible. Thank you for attending today's program. Have a great day.